One thing we can all agree on is that inflation sucks. If you have cash, if you're a saver, you're losing purchasing power to inflation. It's known as the invisible tax for a reason. You don't see it because a dollar is still worth a dollar, but it doesn't buy you as much in the future. So the ultimate question is, what do you do about it? Do you just take it? No. You can invest in different vehicles or investment vehicles in order to counteract that inflation. Once you learn inflation eats away at your purchasing power, that should be the day that you realize you can't just save your money, you have to also invest it. So in this video, we're going to talk about some of those investment vehicles that you can invest in order to protect your money and protect your wealth, and at the same time, grow your wealth. The reason I'm even talking about inflation is because of the CPI report that came out last week, showing an increase in inflation of 4.2% year over year from April 2020 to April 2021. Looking at this graph though, it's clear that energy being up 25% is clearly an outlier move. If you look at something like crude oil for the past year, the low point in the price was around that April month. So comparing April 2020 versus this year, you're going to see a huge swing in energy prices. So it probably makes more sense to use something like all items less food and energy for around 3% inflation, which is still pretty high. Now, you may hear the term transitory inflation, which the Fed throws around. Basically, it means there's a couple months where we'll see higher inflation because the comparative period we had low inflation. So with the reopening of the economy, as well as them printing a ton of money into M2 money supply, therefore, there'll be a period where we should see higher inflation and then it should cool off. Now let's talk about that money supply, because since 2019, it's up around 26% or $4 trillion of increases in the M2 money supply. And if you think about it, because the supply of money has just increased out of kind of thin air, you have an effect where the money that you currently have would be worth less because there's money being introduced into the supply, devaluing your current dollar, or inflation. The reason we see this spike in money supply is because the Fed stepped in with quantitative easing when COVID started to backstop the economy, which was good, right? You don't want to have a free fall and have mass chaos. So they stepped in, started buying government bonds to increase the money supply, which spurs purchasing, investment, all that good stuff to keep the economy afloat. Now, when the economy starts reopening though, if they don't increase that interest rate back up, all of a sudden you can be creating a bubble because all of this money needs to go somewhere, so it will go to assets. So you have increases in stocks, crypto, real estate. All of these asset classes are at all-time highs. Now, this video isn't to talk about some bubble bursting or we're gonna go into a super mega bear market and you're gonna lose all your money, right? This video is more about what investment vehicles do well when inflation is higher. One asset class that tracks very closely to inflation, meaning there's a positive correlation, is commodities. So think of oil, corn, soybeans, you name it. The commodities have a positive correlation, and according to a study, there was about a 3.5% increase in the commodity index for every 1% raise in inflation. One of my plays in the portfolio, Nucor, would be a good position because it's in the steel business, and that would be a basic material, and the pricing of that steel has gone up with the fear over inflation as well as the reopening of the economy. I also own VDE, which is an ETF that focuses on the energy sector, and really it's mostly oil stocks. So oil would also be a basic material or a commodity that would do well in a high inflationary period, or the companies that are producing the oil would be making more money due to the increase in oil. This next investment class you may have guessed was going to be in here, but real estate. It's another way to protect your money versus inflation. Here's a data set showing the price appreciation of homes versus CPI. And over time, it tracks very well and actually outpaces inflation. So being in real estate or having investments in rentals or residential buildings, anything like that, does well when it comes to protecting your money versus that inflation risk. One of the perks also when it comes to real estate is the leverage. And the leverage helps when there is inflation going on because the value of that debt gets lower and lower. Because if you think about it, if you have a fixed rate for a mortgage and all of a sudden the dollars in the future that you're paying against that debt, those dollars or that debt is worth less in terms of purchasing power. So you can have leverage, buy a house, and have that pace with inflation. Meanwhile, you paid for that house with debt, and that debt, the value of the debt goes down over time. At this point in my life, I don't have any physical real estate, something I'm definitely interested and will get involved with eventually. But right now, the way I play real estate is through ETFs such as VNQ, which is a REIT, essentially, or it's a compilation of REITs. REIT just stands for Real Estate Investment Trust. Another sector that does well is the banking sector, because we talked about earlier how the Fed decreased the federal funds rate to put a backstop on the economy. Eventually, in order to avoid too much inflation, they may raise the rates, which that increase in the rates, banks actually make more money because they can get savings or deposits and they can loan it out at higher rates. So their margin expands, or their spread expands. In my portfolio, I have companies like Bank of America, JP Morgan, or even Ally Financial. Now you may be asking yourself, hey, where's the gold? Gold is the ultimate hedge against inflation. What was interesting is the more I researched, I realized gold isn't necessarily the best hedge for inflation. While it can go up and it's considered a store of value and it's also a commodity, it doesn't necessarily have to be correlated with inflation. And we'll see based on this chart. Here's a chart of the gold price over time since 1971. But if you scroll up, there's actually a 0.28% correlation with the CPI index if you overlay the inflation numbers. So what that really tells you is, yes, gold can have years where it is positively correlated, or it looks like it's positively correlated with inflation. So inflation goes up, gold goes up, but with this correlation of 0.28, realistically, it's not that strong, meaning you don't necessarily have to make money if inflation goes up and you own gold. Now, what that does tell me about gold is that it's an uncorrelated asset, meaning if you have gold in the portfolio and there's a huge scare in the market, bonds go down, stocks go down, everything goes down, gold actually may hold up because it's more of a store of value, and the value of gold is based on not just the correlation with inflation, but sentiment as well as use cases for gold applications. There you have it. Real estate, financial stocks, and energy stocks all do well when inflation is high. If you did enjoy this video, give it a thumbs up and consider subscribing to Main Street Wolf, where we'll talk about investing, crypto, anything to do with money in the future as well. Thanks guys for watching, and have a great day.